Hi everyone, my name is Matthew Griffin, better known as the Fanatical Futurist. I'm the CEO and founder of the 311 Institute and the World Futures Forum, and it's a pleasure to be with you today, albeit virtually, which is kind of the way that we're doing things now. And for this particular presentation, this is probably quite appropriate as we look forward to the increasingly digital age. Now, as a futurist, my purview is the next 5, 10, 20, 30, 40, 50 years. I track hundreds of different technologies across every single sector. I work with governments, I work with multinationals, and I work with a lot of the brands that you're actually using now, right now. So during this presentation, this is sort of actually quite a passionate topic of mine. I'm going to be discussing basically this: fintechs, enablers or disruptors, good or bad? And you'll see what I mean by that latter statement in a little bit. So when we have a look at the future, the one thing that we all have to get on board with is that speed matters. And the reason why this is important is because today the rate of change is accelerating and it's becoming incredibly fast. So for example, we now have 3.5 billion people around the planet connected. Those people, because they are connected, have almost instant access to almost any and every digital product or service that you or I create. And as a consequence, when we have a look at the rate of change, if you step back to the sort of 1900s, it would have taken typically about 75 years, 50 to 75 years to disrupt a global industry. However, as we saw with Pokemon Go was adopted by 50 million people within the space of a couple of weeks. Call of Duty was adopted by 100 million people in 6 days. But when it comes to the financial services industry, we can do a lot better than that. We can disrupt the global financial services industry and the state's control of money and the general banking and payments system within a day. And if you doubt me, have any of you heard of Libra? So Libra was released by Facebook in June 2019. It was a cryptocurrency made up of a variety of different fiat currencies and everything else. Now, to quote the regulators and the chairman of the People's Bank of China, the chairman of the European Central Bank, the Bank of England, and the US Federal Reserve, Libra could have changed the state's control of money overnight. It could have changed the global financial services industry overnight. And from Facebook's perspective, it could have actually given them outweighed control over foreign exchange rates because of that basket of currencies. Now, in this particular case, we have a company, a tech giant that creates a digital product, a cryptocurrency in this particular case. They could have pushed it live at 9 a.m. if the regulators had let them. By midday, they could have had 100, 2, 3, 4, 500 million people using it. By the end of the day, they could have actually had 3.2 billion people using it if they all adopted it. And as the regulators said at the time, they said, we didn't really have a problem with the concept of Libra. What we actually had a problem with was Facebook, the company itself, and our ability to trust them, etc., etc., etc. So we are already living in an age where you can disrupt a global industry, an established global industry, in a day. And this speed's getting faster. And fintechs, for example, are able to tap into this speed, as are most digital organizations. Now, as the head of strategy at JP Morgan says, digital is a once-in-a-generation shift, which is why I guess they are spending $13 billion every year transforming their bank. However, the other thing that digital does is it breaks down all of the previously distinct boundaries between all of the previously distinct and siloed industries. So, for example, if I go and have a conversation with a bank and I say, what industry are you in? Almost every bank will give this reply. Stupid. We're in the financial services industry. We provide loans, savings, mortgages, financial services products, wealth management, etc., etc., etc. If I ask a retailer exactly the same question, they will again say, stupid. We sell stuff. If I go and ask a car manufacturer what industry they're in, well, stupid. We're in the business of selling cars. When you go and ask a digital organization, for example, the global tech giants, the exact same industry, and say, Google, Amazon, Alibaba, Tencent, the Fatbag crew as they're known, what industry are you in? They'll go, stupid. All of them. Because when you have a look at companies like Amazon, Google, Facebook, etc., 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 they are in retail, they are in finance, they are in healthcare, they're in logistics, they are in entertainment, etc., etc., etc. So once your organization becomes a digitally native organization, that's just your starting point for disrupting not just your own industry, but other industries around you. And it gets better. So from my perspective, personally, I think the banking system is actually broken. And I'm going to walk you through why I think it's broken. And I'm not going to play a blame game. It's not your fault. And the reason why I think it's broken is because as an industry, it's not about you. It's about your customers. Now, how many of you have got bank accounts? All of you? Great. How many of your banks are actually giving you a good return on your investments? In short, I could actually argue that banks are the Facebook of the finance world. So we constantly complain that companies like Facebook and Google treat customers as the product. I give my data to Facebook. Facebook sells the data for revenues and profit. In the banking industry's case, I give my money to the banking industry, and the banks then loan my money out for revenues and profit, while giving me an incredibly small slice of that. If you have a look at interest rates around the world, typically we're in a situation where we are lucky if we are being paid 0.5% return on our savings. So you have my money, but I'm lucky if I get a couple of pounds back in interest at the end of the year. It doesn't seem fair. In addition to that, as banks, you'll then be loaning out my money at anywhere between 25 to, in some cases, 2,000% compound interest, which is crazy. Now, when we have a look at this, as I say, it's not your fault. You're fine. We can blame the Medicis. So in the sort of 1300s and 1400s, basically we saw Bank One. So Bank One basically was the Medici bank. And the Medici family thought, well, there must be a way that we can bring all of this money together, keep it in a safe place for customers. Yeah. So that was really the first bank. As part of their evolution, the Medici bank then thought, well, if we actually have all of this money in our vault, maybe we could actually loan it out. And this is where, ostensibly, the modern loan system came from. And so I would give the Medici bank my money. They would keep it safe. That was their value to me as a customer. And then they would loan that money out, and that's where they'd make their revenues and profit. We then sort of in the 1960s moved into Bank Two, basically with check processing, basically on the west coast of California with organizations like Citigroup, and we entered the mainframe era, basically with IBM mainframes like Irma, the first check processing system. Then in the sort of 1980s, basically we saw Bank Three, self-service, so I no longer have to actually go to the bank to get my money out, I can go to the hole in the wall. However, the business model of banking is still broken because you're keeping my money, so you're keeping it safe. That's a value, and that is a service, and I'll maybe pay a premium for that. However, I'm still really not getting much back from that money. Now, when we start having a look forward, basically to Bank Four, increasingly Bank Four, hardly any surprises, is automated. It's autonomous. That is different from automated. An automated system is something that just does A, B, C, D, based on a set of rules that if this, then that. Autonomous systems are capable of making their own decisions. So they will then autonomously decide whether we take your money and invest it in this or in this, based on all the different risk criteria and information they see at the time. So these are artificial intelligence systems They're machine learning, they're increasingly deep learning, and deep learning gives the financial services regulators a massive headache because deep learning artificial intelligences are essentially a black box, which is where we then get into later conversations about explainable artificial intelligence. Yeah, why did your thing invest in that thing? They're also digital, no surprise there. They are frictionless. Now, when I say frictionless, this is where we can bake in a lot of automation into the customer experience and the UI, and the system just looks after our money for us. And at the end of the day, that system, hopefully, if we can fix the business banking model, just says, by the way, I made you loads of money. Now, they're also hyper-personal because they can take huge amounts of information from me, both online and offline, which is a privacy conversation. And they can really start figuring out my risk profile, based on my behaviors, my habits, basically maybe even what my aspirations are, and they can kind of predict and adapt accordingly. Now, when we start having a look at this future, by the admission, basically Barclays, Bank of England, basically Citigroup, Deutsche, HSBC, they say that in the next sort of 5 to, not really 10, but sort of 5 to 8 years, over 50% of all banking jobs will be automated. We've already seen this with organizations like Goldman Sachs. So equities traders basically are pretty much fully automated. Basically, we are seeing, I'll leave that one to a little bit later, but we're seeing a variety of, should we say, financial consultants, basically, and advisors actually being automated as well. And I'm going to introduce you to mine. Now, when we have a look at the business model of banking, when you go and do surveys and you have conversations basically with younger generations, and this is highly relevant basically when you think about the future of your own banks and your own products and services, as well as your own marketing and communication strategies. Depending on the country that you're in, 54 to 94% of younger generations oppose traditional capitalism. Now, traditional capitalism is kind of based on the ethos of profit for profit's sake at the expense of everything else. Traditional capitalism is increasingly being blamed for treating workers as commodities, for the raping and pillaging basically of the natural environment, for pollution, for the polarization of society, the increasing wealth gaps, and so on and so forth. Traditional capitalism, which kind of comes from that Medici era or even sort of before, is increasingly not the model that younger generations want to embrace. So, for example, when we actually have a look at the concept of ethical capitalism, where we talk about things like the mutuality of financing, how are you promoting your products and services, or how are you communicating with your customers to say, by the way, okay, we have your money, but we're doing good things with it? My banks do none of that. And I work with some of the world's largest banks. As far as I'm concerned, I give them my money. It goes into a black hole. They send me a bank statement. They don't even give me a thank you. Thanks, you know who you are. So, as we said earlier, once you become a digital organization, embrace the multi-sided platform model. You're a bank today, you can provide insurance services tomorrow, you can provide transportation services, you can sell stuff. You can sell holidays. Once you're a digital organization, you can go into any market with impunity, just like the tech giants. And these are the markets that the fintechs are actually primed to move into. Now, when we actually have a look at the incumbents within the banking industry, let's say, for example, we take the world's top 400 banks by revenue, and again, you know who you are. Let's talk about defending the castle. So, a fintech camped on your lawn. Now, when we sort of step back about 5 to 10 years ago, most incumbents would have these reactions. A fintech has camped on my lawn. They do something that I do in new ways. Do I kill them? Do I partner with them? Or do I buy them? However, I call this the 7 stages of grief. Now, from an incumbent's perspective, you've got a fintech or a couple of fintechs now on your front lawn. This is generally the response. And this isn't just the response of disruptors coming into the financial services industry, this is the exact same response that we see exhibited with every single industry on earth. Fintechs camped on your lawn. Everyone's telling you that they are the new hot thing. They are going to disrupt you. As an incumbent, you reply, disruption's overstated. Long live the status quo. Then you mock them because you look at them and you go, they stand no chance. We're a big brand. We're highly capitalized. And as one bank said to me a little while ago, we have 25 million mobile users. At which point, Facebook then got an e-commerce license or an e-money license. And from Facebook's perspective, with their 3.2 billion users, do you really think that Facebook care, basically, that they just rolled over your 25 million users and didn't even notice that they ran over your business? Yeah, but nevertheless, as an incumbent bank, you look at fintechs and you mock them. They stand no chance because they've got no money, they've got no real backing, they've got no market traction, they've got no real customers. So what? Nice gimmick. Mock them. Then the next thing happens. You're bamboozled. And this is the first time I've ever used this word in a presentation, but it's a good word. So they grew and they got customers. Who knew? And then as these fintechs start growing, getting bigger, starting eating into your revenues, your profits, your market share, your customer base, etc., 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 this is where inevitably most incumbents will then start throwing sue balls at them. You can't do that in that way because the regulators won't allow it. You get the regulators on your side and you go to the regulator and say, look at this new thing. This new thing basically is disrupting us and they can't do that. They're not allowed to do that. That's unfair. Can't you do something about them? Can't you just pull their license? Can't you kill them? And a lot of these particular tactics, and it's not just the financial services industry, it's every industry. Some of these tactics are to simply slow those new startups and those new entrants down, which then gives you time to react, think of a strategy and implement a strategy, bearing in mind that with the large majority of big incumbent banks, it can take years for them to spin on that dime. Or, in the best case, you kill them. That's it. In which case, it's kind of a win-win. That's it. But nevertheless, sue balls and regulation follow. Now, a lot of those sue balls fail. The regulators look at these new startups and they go, well, actually, you know what? We quite like what they're doing. So we're just going to let them run. We've seen this with companies like Uber and Airbnb. As I say, it's not just unique to the financial services industry. And all of a sudden, basically, the incumbents go, hang on, these startups are starting to eat into our market share, our customer base, our profits and revenues are being affected. The regulators have actually approved them and actually support them. They're growing, they're getting investment, they're now worth multi-billion dollars, etc., etc. And now at the boardroom, and I see this time and time again, now at the boardroom level, you have the CEO, the CFO, basically the CIO, CTO, CXO, the entire suite going, what's our reaction? What do we do about this fintech, basically, that is now not just sat on our lawn, they're now starting to break into our building? So this is where companies like Santander, for example, and Barclays suddenly went, whoa, what we're going to do is we're suddenly going to invest in innovation accelerators, like Startup Boot Camp, like Techstars. We're going to have a war chest. We're going to put together 100 million euros and we're going to use that to fund new innovation. We're going to start looking at our own culture. Are we fast enough? Because we're a lot of people who wear suits. And frankly, when it comes to change, disruption, innovation, and everything else, we aren't really sure where to start. And frankly, it all makes us rather uncomfortable. So they have this panic and this sense of urgency setting in. And if you have a look at the news headlines across the years, you'll see this with almost every single bank and also every single incumbent in every other industry. So now basically you've got £100 million to invest in innovation, R&D. You're working with ecosystems, cohorts and accelerator communities to try to find the new thing that you can tie into. Then we get to this question. Do I partner with these startups and these people who are trying to camp on my lawn? Do I take equity? Do I now go to them and rather than saying, I'm sorry I tried to kill you and sue you, would you like to partner? And maybe when we partner, we could send you an RFI and an RFP and we could become your customer. We love you, really. Yeah, it's cute. Or, as we sort of see basically with Visa and MasterCard and all these other organizations, eventually you move from partner to buy. And again, buy gives you a couple of options because you can do an acqui-hire. You can integrate that new startup's products into your own legacy system, and you can then start selling that, or you can kill it. And actually, we do see a number of people buying companies to kill them. And the cycle continues. Then another fintech lands on your lawn, and we repeat. However, back to the question that's at hand: fintechs, disruptor or enabler? Now, when you actually have a look at this, now, if you remember, I said that younger generations basically are increasingly opposed to the idea of traditional capitalism, and they prefer more ethical capitalist models. 73% of millennials say that they would actually bank with organizations like Apple, Google, and Nike. Nike don't even have a financial services product. But again, it kind of comes back to that sort of situation where, yeah, I don't like banks. What are they doing for the environment? What are they doing for me? What are they doing for the community, etc., 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 which is a marketing problem, but also a product and services problem and an industry perception problem generally. In addition to that, when we actually have a look at some of the other metrics here, 57% of people are really worried that their data is going to be compromised or their bank accounts are going to be compromised. When we have a look at platforms like Venmo, when was the last time that anything that your bank did got turned into a verb? So we talk about, hey, can you just Venmo me the money? And then in addition to that, when we actually have a look at millennials, 50% of millennials, easy for me to say, 50% of millennials say that they intend to switch banks in the next 12 months, which then leads us to the question, how many of them actually do? And 18% of them do. However, we also see 71% of millennials saying they would actually rather go to the dentist than talk to their bank. What does that tell you about your customer base? Or the value proposition that you have, or your marketing capabilities. Come and talk to the bank. No, thanks. I'd rather go and have a chat with the dentist. That's it. Now, when we have a look at robo-wealth advisors, for example, 14%, this is a survey from HSBC, this isn't even some random survey, 14% of customers would trust a robot to do open heart surgery on them. But from a fintech perspective, because this is more the domain of fintechs, admittedly, than incumbents, only 11% of people will actually trust an artificial intelligence, wealth advisor. So when we start having a look, for example, at the automation of advisory, we've still got a big culture gap. And that's actually quite good for incumbents because it gives you some time to react. Now, when we actually have a look at fintechs basically versus incumbents, frankly, fintechs have got a really, really pretty interface. It's quite frictionless. It's on my mobile. It's relatively easy to understand. It can show me what I've been doing with my money and all those sorts of things. I love my fintech user interface. But it's still the same broken business model because when you have a look at Starling, when you have a look at Monzo, when you have a look at all of these different organizations, all of these fintechs have exactly the same business model basically as the Medici banks, where they say, customers, use us because we love you. They have different messaging. Secondly, give us your money and we will provide you with this beautiful, elegant interface that the incumbent banks won't or can't. But once we have your money, we'll give you a measly return on that money. You're welcome. And we will then, like the Medici Bank and like all of the other incumbents, we will then take the money that you've graciously given us because you are the product, and we will loan that out at 25% compound. Thanks. So fintechs are just the same as incumbents, but they've got a really nice interface. And of course, fintechs basically will come to me and go, we don't just do that. And I know that, but when you really bake it down, it is the same business model. Come and try and deny it. We can have that conversation in a bit when in our Q&A. However, look at this. So this is sort of pandemic data. During the pandemic, 64% of all new bank accounts were opened with fintechs. 29% of the people who opened bank accounts, all the bank accounts, deposited $100 or more into a fintech bank account. The cost for those fintechs to open that bank account, by their own admission, this is like data from Monzo, for example, was basically zero. But in addition to that, from a fintech perspective, the cost of managing that account over the course of a year was $25. Now look at the incumbents. 36% of new accounts were opened with incumbents. 71% of people who opened bank accounts deposited more than $100 with an incumbent. But from an incumbent perspective, it typically costs them about $150 to open a bank account, and it costs anywhere between $250 to $450 a year to manage that bank account. So on these numbers, fintechs win, but the story isn't quite as straightforward as that. So as I've mentioned, fintechs are convenient. They have a lovely, lovely user interface, very nicely designed by the world's best UI designers who've been taking different colors and swatches and everything else and really thinking about that design. However, a lot of fintechs still lack scale, which is actually why we saw a lot of people moving back to incumbents, because incumbents were highly capitalized, whereas fintechs were in danger in some cases of actually running out of money. That's a conversation for a different time, and you can obviously go and search that up for yourself. Now, fintechs are starting to do some interesting things, though. I mean, they've always been doing interesting things, but they're also doing some other interesting things as well. So, for example, as a fintech, you would go to the regulator and say, I want a license. And the regulators will say, well, it's going to take you about a year to 2 years to get that license, and it's going to cost you about $1 million. We now have fintechs in the UK that let other fintechs access global banking with just 5 lines of code. So if you're a fintech, now all of a sudden you have other fintechs that are eliminating $1 million spend, and they are increasing the speed at which you get access to global banking by a year, pretty much by 100%. In addition to that, when we start codifying all of the different securities and exchange and financial regulations, we can set artificial intelligence loose on it. So in the UK's case, we are using some of the tricks from the fintech world to codify regulations and then get artificial intelligence to monitor and enforce those regulations, which then means that organizations like the FCA are increasingly thinking of becoming a robo-regulator, which is kind of speak basically for an automated and autonomous regulator, albeit in that fintech space. So we have some interesting things coming down the line. Now, the data that I sort of showed you a little bit earlier, from an incumbent's perspective, while you lost 3 out of the 4 battles, you won 1. Over 70% of people who opened a bank account during COVID deposited $100 or more with an incumbent bank, with a traditional player, which means that you still have customers' trust when it comes to keeping money safe. Having their trust when it relates to them believing that you are acting in their own interests and actually doing good for the customer, that's a different set of metrics. But what that particular figure demonstrated was that banks have people's trust when it comes to, I have a load of money, I'm going to give it to you to put in your bank vault. Your digital bank vault, obviously, because Medici bank vaults don't really exist any longer unless basically you're in the US. Now, fintechs are also built differently. And this is their advantage. They have artificial intelligence baked into them. They are automated, they are cloud, they are DevOps by design, they're digital by design. That's it. Whereas the vast majority of incumbents basically are analog, they're legacy, they're manual and on-prem. So if you go and have a conversation with a large incumbent and say, what's your biggest ICT challenge? They will say, well, if we see a new market opportunity, our ICT stack won't let us move into it and take advantage of it for about a year because it takes so long for us to swing. We're not particularly agile or flexible. In addition to that, the vast majority of the larger banks, in some cases, I mean, I know quite a number that actually have over $1 billion worth of legacy infrastructure, things like AS400 mainframes and everything else. Do you really think that when a fintech went out to bat and they sat down and they said, so we're going to build a new bank, what do we think we need? I think we need a giant mainframe. They do things differently. Everything is digital and cloud, basically. It's all plug and play. We plug this thing into this thing, into this thing, and this thing. And then if we don't like this thing, we pull that out, we swap it in basically for another thing, another product, another service, another supplier, whatever it happens to be. However, incumbent banks are actually learning. So this is very much a case of, can we teach an old dog new tricks? Well, absolutely. So for example, when we have a look at JP Morgan, but Goldman Sachs basically here as well, we see other incumbents around the place. I'm a big giant bank. Now, if I want to compete with the fintechs in this modern new world, it's going to take me years to transform my legacy infrastructure. You know, it's a 3 to 5 year job in some cases. And frankly, the markets are moving a lot faster than I can. So as an incumbent bank, you're then left with this kind of choice. Well, if it takes me a very long time to transform my business operations, my ICT stack, and all these kinds of other things, how can I really leverage new technologies to take advantage of new markets in a similar way, basically, to the disruptors, the fintechs do? How do I take a card out of their book? Well, in JP Morgan's case, for example, they start almost from scratch. They create a digital bank that is digital from the ground up. And then they have hooks, basically, from their digital bank, which they're launching in the UK this year, back into the giant bank. But ostensibly, the digital bank lets them go and attack the fintechs and disruptors in their own ballpark, on their own lawn, while giving companies like JP Morgan the time to transform, adapt, and react.
Today, we're all being disrupted. And I'm not just talking about by digital humans like myself with our conversational artificial intelligence, state-of-the-art high-def rendering, and neural networks for brains.
Now, I did say that big incumbent banks basically are learning. So this is Anna. Anna is my own digital employee. She's a digital human. Increasingly, these digital humans have neural network brains that allow people to talk to them using natural language, ask them questions, and then these digital humans can come back using natural language and say, this was your question, this is the answer. Or, I've done that for you. Now, I said incumbents were learning and taking a leaf out of the playbook of fintechs. This is Cora. Cora is a digital human that is being used by NatWest. And Cora is managing banking and account inquiries, loans, payments, mortgage advice, and even travel advice. A traditional banking incumbent would never have thought of using a digital human as part of their customer service mix or customer support mix. In addition to that, organizations like JP Morgan are starting to use robo-lawyers. So again, this is another playbook, but this isn't out of a fintech playbook. This is out of a law tech playbook. Remember, there's lots of interesting things going in the adjacent industries around you. Do you know what they are? Do you have a point of view? Do you know how you could use them or leverage them for your own disruptive ends? In JP Morgan's case, they recently used an artificial intelligent lawyer to reduce the amount of legal work that they had to do by 465,000 hours. They are taking a page out of the digital playbook the exponential technology playbook, and the startup playbook. And it's working well for them. In addition to that, when we have a look at KYC, we have organizations like KYC Chain, where we now have KYC in the cloud that you can just tap into. And again, from a fintech perspective, why build my own KYC system? Okay, I could own it and I could turn it into a proprietary store of value and everything else, but why not just plug into theirs, pay them a service? And again, when we actually have a look at the way that core banking systems are actually changing for regular incumbents, increasingly it's a why build it yourself when you can just plug into someone else's? It feeds into that agility and flexibility and the ability to move at speed play. And then this then brings us to this, which is the roundup, it's the summary and everything else. What is fintech's lasting legacy? Are they a disruptor or an enabler? Now, on the one hand, fintechs, I say when they first emerged, but when we sort of ended up going through the hype cycles, fintechs caused a lot of panic within the traditional financial services community, which then created a sense of urgency, which is when we then saw huge investments in research and development, innovation accelerators, doing new things in new ways, culture reform, etc., etc., etc. However, their lasting legacy, and as to the question of are they a disruptor or are they an enabler? Sure, they disrupted a couple of things, but really they disrupted the interface. And they disrupted things like payment systems, instant payment systems, blockchain-based payment systems, the global payment systems like SWIFT networks, etc., etc., etc. It's a slightly different conversation, but nevertheless. The biggest impact that fintechs have had on the global incumbents is this. They have enacted a massive, massive culture change. And every bank, frankly, should learn from a fintech. So they are enablers, but they are enablers in a broken business model. Because as I said, fintechs have a very pretty interface. They do old things in new ways. They do new things in new ways. But fundamentally, from a customer perspective, they take my money, give me very little back, and then they go and spend my money elsewhere. So, is the real opportunity here to act like a fintech? Or is the real opportunity here to transform your business, your products, your services, your culture, your marketing and communications, and actually work with customers in new ways to deliver new things basically that align with their values and their sense of purpose and the world at large? And we'll be asking a lot of those questions in the Q&A session. So I hope you enjoyed the presentation. Thank you very much. My name is Matthew Griffin, and I'm going to be available for Q&A in a couple of minutes. Take care.